Trying to bounce back from the worst week of 2023. Live from New York City this morning. Good morning, good morning. Equity futures up about 0.1%. Counting you down to CPI. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Ferro.
Live from New York, coming up, stocks on hold after the worst week of 2023. Investors looking ahead to a crucial inflation print, and US-China tensions continue to simmer. We begin with the big issue, the market's next big test.
A big CPI report coming up.
We have CPI looming
on Valentine's Day.
Powell essentially is telling us they're data dependent.
He basically said, all right, you guys want to play data dependent? We'll play data dependent.
It's not clean sailing for the markets.
That CPI print is kind of a sneaky risk event.
We could get some more bumpy inflation news.
Investors have largely assumed away inflation risk.
How sticky will inflation be around this very critical 4% level?
If you were to get a little bit of a surprising print there,
it could be the case that US CPI comes in hot.
It's the kind of thing that could A, disrupt the rally, and B, I think embolden people to kind of lean against the rally we've seen.
CPI is going to be interesting.
This number could be a spicy one.
Joining us now to discuss is Morgan Stanley's Jim Karen, Matt Miskin of JH Investments. Gents, great to have you with us. About 30 minutes away from that opening Powell futures up 0.1%. Chairman Powell last week talked about the disinflationary process beginning. Now, I wonder, Matt Miskin, is the CPI data tomorrow going to contradict that or support it?
We think it's going to contradict it. It likely is going to come in spicier than expected. Used car prices coming in hot in January, gas prices hotter. But overall, we see there a downward trend in inflation. The year-over-year comps are going to be going through the inflation perfect storm of 2022. And we think overall those comps are going to be flattering over the course of the year. But we are not looking forward to the CPI report coming in on Tuesday.
Jim Karen, do you agree?
Yeah, look, I think what Matt is saying is correct, but this is a well-anticipated bump in the road. And essentially, I think a lot of people are expecting this number to come in stronger. So maybe the bar is set a little high to surprise to the upside, but if it comes in a little bit lower, then maybe there is some positive reaction in asset prices as well. I think it's important the way that Powell has been framing the discussion, that it's really more about trend inflation moving lower, and we do think it is going to decline over the first half of the year for sure.
It's not just CPI data this week, it's retail sales as well, and the hard data has been pretty tremendous year to date. I was just going through the research this morning. Matt Miskin, this from Mike Gapin of BofA. The US economy is revealing itself as difficult to slow down. Andrew Hollenhorst, the City on the same page, data pointing to a longer expansion. Vishy Tirupattura of Morgan Stanley, Jim Karen's colleague, we think the hard data are too strong for this Fed to look past. Now, Matt Miskin, if you're in that camp where you think this economy is going to slow down, where's the evidence for it?
Yeah, so monetary policy works with a lag. What we see from economists right now is that is the biggest miscalculation, is that right this time last year, interest rates were zero. And we still were living off 2021 stimulus, and you had, basically an economic boom. But what we're seeing is over the course of last year, the Fed raised rates aggressively. The yield curve inverted in the middle of last year. Usually it takes 12 months after yield curve inversion and after tighter monetary policy for it to show up in the economy. Monetary policy works with long lags, 1 to 2 years. That's going to likely show up in the middle of the year. And that is going to put dampening, basically higher interest rates will cause dampening growth in our view over the course of the year. We still see a recession in the back half, but we would not, go over your skis and risk assets just because January has been a little bit better than expected.
So, Jim, there are two responses available to anyone who has to answer that question. One is what Matt just did, which is there are lags and it will show up eventually. The other response is we're just not sufficiently restrictive. How do you come down on this one?
So, in some ways, it could be that we're not sufficiently restrictive, but I really come down on it in terms of just thinking about the expectations in the markets and the pricing. I think that there was a large expectation that we would see a dip or decline, significant decline, whether it was in jobs or the economy in the first half of the year. And so far, the evidence, it's not showing that. John, as you just said, some of the data coming out is much stronger than people expected. But remember, CPI is coming down. inflation is coming down. We are starting to see some job losses as well in terms of layoffs. All of these things are happening. It's just that people expected way worse of this to actually occur. That and the fact that there's been a lot of cash on the sidelines in anticipation of this bad news, bringing prices lower, and that hasn't happened. So now you're seeing all of this cash start to move into markets to try to chase returns. So it's really a question, I think, of timing and technicals and positioning in the markets at this point. And maybe the market prices are overstating what might be some of the positive data in the markets. But then again, technically, people were just under risked. And as I like to say, risk on is a risk, and people weren't hedging that risk well enough.
You said that coming into 23. You said that on this program. Equity futures right now up 0.1% on the S&P 500. US CPI headlining a big week for markets, including retail sales as well. Mike McKee, a busy one for you, sir.
Yeah, at least, though, I want to point out that everybody hates getting up the morning after the Super Bowl, and we have no economic indicators today. You're welcome. The rest of the week, however, we got to squish them all together, and there's a lot going on that will tell us a lot about prices and a lot about the economy. Obviously, we start with CPI tomorrow. That's the big number of the week, other than retail sales, which comes up on Wednesday. We get a lot of Fed speak this week, not only are we speaking with Tom Barkin of Richmond tomorrow, but Lori Logan and Pat Harker and John Williams all speaking tomorrow. Industrial production comes out on Wednesday. Spring training opens, for those of you who care, on Wednesday. And then starts and permits, jobless claims, Philly Fed, and PPI on Thursday, along with 3 more Fed speakers. So you've got a lot of news that will shape perceptions of what the Fed is going to do. None more than the CPI. I'm glad to hear your guest, John, talk about the fact that this is anticipated, because the lean is towards a higher CPI for the month of January for 2 big reasons. One, seasonals have changed, and you can see where I circled there. Those have been revised up. Last month, it was a 0.1% decline in December CPI. That's been revised to a 0.1% gain. So we're starting at a higher level. Core also revised higher. So we could see a higher than expected CPI report, but if the markets are expecting it, won't be a big deal, which raises the question then of what happens when we get to retail sales, because remember, November was bad and December was terrible for retail sales, and everybody was talking about the economy finally slowing down. Look at the forecast for what's supposed to happen for January retail sales. A gigantic rebound. Is that going to upset the markets as well? That's another question we'll get answered, I guess, by the end of this week.
It's a really important data point coming on Wednesday. Mike, looking forward to your coverage of it. Equity futures right now up 0.1%. The same market, this is why I love markets, the same market and 2 completely different views on it. Here's Wells Fargo with Chris Harvey this morning. The bear market is over, the new scenario is in play, and it's wheels up, where growth takes off after an aborted landing. Our base case is a non-hard landing. Here's Mike Wilson of Morgan Stanley. Price action is not reflective of the deteriorating fundamentals or the fact that the Fed is hiking during an earnings recession. Price is about as disconnected from reality as it's been during this bear market. Matt Miskin, that line from Mike Wilson, price is about as disconnected from reality as it's been during this bear market. Do you agree with that statement?
It's pretty close. Yeah, John, I watched your Twitter this morning and got, just thinking, wow, we got it all figured out. 2 completely different views. And, what is priced in? Everybody was bearish. I totally understand that everyone was bearish. Sentiment was negative in the fourth quarter. And now, though, you're starting to see more people bullish. You're getting these, it's no landing. It's no landing at all. We're not going to see a recession. And I think, you just got to be mindful that things work with a lag again, and that right now we're trading at very high multiples. The S&P is trading at about 18 times earnings. That is an elevated price to earnings ratio. We're trading at, in terms of high yield spreads, credit spreads, they're 400 basis points. They came up a little bit last week, but still historically tight. There's other risks out there. There's geopolitical risk. There's, other risks in terms of the economy that we don't think is really priced in at the moment. And so we are still with a modest, cautious tilt in terms of our views, a bit more defensive and looking for higher quality options across portfolios.
Matt, I'm guilty of throwing around a term that is still pretty loosely defined, but let's build on it if we can. No landing. If we get a so-called no landing, 1, tell me what that means to you. And 2, is that bullish or not?
Yeah, so I mean, right now, if you win, you kind of lose. And I know that doesn't make a lot of sense. But what I mean by that is if we don't get a landing, which means that the economy doesn't even slow, that the economy just continues to go quickly and grow, then the Fed's going to raise rates more. And they're going to get that landing one way or the other. And so in our view, you got to be careful because the Fed is still raising rates. It's not late. The cycle still needs to get through rate hikes before we can see the other side of this. And because the Fed's still raising rates, the ECB is still raising rates, the Bank of England is still raising rates. We got to get through this tighter monetary policy until we move on to a new cycle.
Jim Karen, you told us that people were holding too much cash. Is that still the case?
I think it is. And look, I mean, I think this is really a discussion around earnings and valuations. So essentially, earnings are coming down. The economy is slowing. There's no question we're seeing that correction in earnings. So I think Mike Wilson's absolutely correct. But what's happening, though, right now is that people are looking through this earnings trough, and they're seeing it as a trough, as a correction, and they're willing to pay a higher multiple or a higher valuation for those earnings because they're looking through it. The reality is that people came into this year with expectations, and there was still, I think it's over 65% expecting a recession in the first half of this year in terms of some of the estimates that I've seen. If that doesn't happen, if we start to build in the probability of a soft landing, and if we start to build in the probability of no landing, then essentially what you have to start to do is think about this correction or this downturn in earnings, look through it, and then look at the valuations. So equities are trading at a one-year forward PE of about 18 at this point. Yeah, that might be a little high, but the point is, though, is that if we do get higher prices, people still have that cash on the sidelines, and they're going to need to chase those returns. So maybe they overvalue the markets at some point. And to me, that's a risk, but that's a risk in the second quarter. It's not a risk right now.
Let's talk about this strong data. Jim, so Vishy put out a note on Friday. Vishy Tripatura of Morgan Stanley, your colleague, said the hard data were too strong for the Fed to look past. And it raised a couple of questions, Jim, whether it reintroduces the risk that the terminal rate is higher than we thought it was 12 months ago, and that maybe even the neutral rate is higher than we thought it was 12 months ago, never mind 12 minutes. How long do you think we have to wait before we get clarity on those two issues?
So John, now I think you're getting to a really good point here, because let me just say that one of the things that's changed with the Fed is that they've adopted as their base case a soft landing. So what that means is that they're willing to hike interest rates maybe towards that 5.25% level. And if you ask me, that's the terminal rate. And essentially not push back against an easing in financial conditions. So if you get higher equity prices, tighter credit spreads, that was viewed as from the Fed as inflationary or a threat to their inflation view. But today, given that they believe that we are in a disinflationary environment, they're allowing themselves to look past this, and they're allowing these financial conditions to ease and let asset prices rise without feeling the necessity to push back against it. So in some ways, I don't want to say it like this, but you could have your cake and eat it too, where the Fed's terminal rate is still around 5.25%, so not too high, but just about right. And essentially, you end up getting higher asset prices. And a lot of this is because the jobs market is still very, very strong. Consumers are strong. Real incomes are going up. Revenues are strong because of inflation. All of these various things are taking place that's really changing the landscape, allowing the Fed to be a little bit easier and let these asset prices run a little higher.
So, Jim, are you tactically bullish? Is that the way you'd characterize it?
Yeah, absolutely. You know, we've been adding to more positive positions in our portfolios since December, and we would see the CPI event, depending on how it comes out, as potentially a tactical opportunity to buy a dip.
Matt, I'm guessing you take the other side of this.
Yes, sir, John. We'll take a little bit more conservative tilt. Higher quality fixed income on the equity side. We're trying to manage valuation risk and solvency risk, frankly. That's bringing us more in the mid-cap space. But to us, equity store, not a lot on sale. Bond store looks a little bit more attractive to us.
Heard a lot of that coming into 23. I wonder how much of that's changed already. We'll pick up on that in just a moment. Matt Miskin, Jim Karen. We're about 20 minutes away from the opening bell. Let's pick out one stock. Man United in the pre-market. Great reporting from the team here at Bloomberg about 15 minutes ago, which says Qatari investors are set to make an offer for the club in the coming days, according to people familiar with the matter. That stock is rallying in the pre-market. Coming up on this programme, flying objects stoking US-China tensions.
They put restrictions on the companies who made the balloon. Does that extend to a TikTok? Does that extend to other Chinese companies that are listed here in the United States? That's where I would be focused if I was an investor.
That conversation up next.
we look at it from a market perspective, number one, we led off this year with saying we could have defense cuts. When we're actively shooting things out of the sky, good luck on those defense cuts. Number two, how did the Biden administration respond to this? They put restrictions on the companies who made the balloon that was shot down. Does that extend to a TikTok? Does that extend to other Chinese companies that are listed here in the United States? That's where I would be focused if I was an investor.
The Pentagon shooting down 4 airborne objects in North American airspace over just 9 days as tensions escalate over the U.S. sanctions 6 Chinese entities over the first object it shot down. Beijing hitting back, saying more than 10 U.S. balloons have trespassed China in the past year. The Foreign Ministry saying the following: the U.S. needs to reflect upon itself and change its wrong practice. Emily Wilkins joins us now from D.C. Emily, what a weird weekend. More flying objects in the United States. Then the Chinese government turns around and says, we found some too. The one question we all had, what the is going on?
That is a question that a lot of folks have in Washington, John, and we're going to see some more hearings looking into this. Remember, lawmakers got briefed last week on exactly what they knew, but that was before this weekend when we have 3 more. We have to call them unidentified objects. There's no confirmation that they're balloons or exactly what they are at this point. And we're really seeing this heat up between Washington and Beijing. I mean, now you're hearing these accusations from Beijing that the U.S. sent balloons over there. You're now seeing the National Security Council saying that that is false, that is not accurate. And there's just a lot of questions about what these objects were doing, what, if any, intelligence they were gathering. And that's the major concern right now. Even Democrats, top Democrat on the Intelligence Committee, Jim Himes, said over the weekend that he wants the Biden administration to be more transparent in the information that they have from these objects. And of course, just a huge test for the Biden administration here. Can they be strong on China? Can they respond quickly to this? You are seeing there's momentum in Congress to move. The House passed a resolution last week condemning the Chinese Communist Party for the first surveillance balloon. That passed unanimously. I mean, in this Congress, that is certainly a shocking statistic and really kind of speaks to how much this has captivated everyone's attention and everyone's interest in this moment.
I mean, it's amazing. We're all following it. We've got very little clarity on the events over the weekend, but already people jump into conclusions about the consequences, the policy consequences. You heard from Ed Mills of Raymond James just moments ago. That was him talking about the risks. He said defence spending, that's very unlikely to get cut after the events of the last week. He talked about the prospect of TikTok being banned as well, Emily. Can you talk to me a little bit more about the consequences, the potential policy consequences after all of this?
So I think TikTok is definitely an area to be watching. You've already seen Congress go ahead and pass a ban on TikTok from being on any federal devices. And that could easily wind up being expanded because there is so much momentum right now in a partisan Congress where not many things can pass. Legislation like this that focuses on China and protecting the U.S. national security interests is one area where you do have a lot of bipartisan support and you do have that momentum to go forward. So I certainly think legislation on TikTok is going to be one to watch. And then certainly with defense spending. I mean, you're hearing Republicans say that they want to find ways to cut the budget as part of raising the debt ceiling. A huge question is whether defense is going to be a part of that. Some Republicans would like to see it cut, but many more understand that it does need to remain strong. And if it becomes an issue between, hey, the U.S. needs to make sure that we're defending ourselves against China, that we are keeping a strong national security stance, that could easily be an argument that winds up winning the day when it comes to defense spending.
Emily, thank you as always. Emily Wilkins down in D.C. It's hard to make that argument when the U.S. military is shooting objects out of American airspace. Remarkable to hear some of these questions being asked of the government. One reporter asking the government if it's possible the objects turned targets were sent by extraterrestrials. And the response from the commander of the North American Aerospace Defense Command was, quote, "I haven't ruled anything out at this point." Do with that what you will. Jim Carrey and Matt Miskin back with us. Gents, a final one from both of you. Sounds ridiculous, almost bizarre, Matt. It is. It's absolutely tremendous to try and follow any of this. How do you frame this tension between the US and China at a time people are getting more and more bullish? Chinese assets.
Yeah, again, I don't think a lot of geopolitical risk is being priced in right now. I mean, you go back to the China trade war days where, every day the market would swing based on kind of what the tweet was of the day or, what the development was. I don't think this is going to be as big as the China trade war type geopolitical event. But again, when valuations are rich, it makes it more difficult. I don't know what the next risk-off catalyst is going to be, but it's easier to have a risk-off catalyst when valuations are fully embedded in asset prices.
Jim, it's a phrase that gets thrown around a lot in financial markets. Geopolitical risk. What on earth is that, and what do you do with it?
Well, it's almost impossible to hedge, that's for sure, because we can't anticipate some of these events. So, look, the way that we think about it in our investment strategies is that there are macro risks or macro trends, and there are micro trends. We can't do anything about the secular risks of U.S.-China tensions. We have to accept those risks that are in the markets. But what I will say is I'll look at the more immediate signs and indicators. China's reopening. It's a command economy. If President Xi wants 5% growth in China, the data is going to show 5% growth. You can believe that or not, but they're going to try to do whatever they can do. That's going to have positive spillover benefits to emerging markets. It's going to have positive spillover benefits even to global growth. All of this was not really being accounted for properly by the end of last year, and it's coming towards us right now. So yes, are there geopolitical tensions and risks, and could that all be derailed? Absolutely. Can we anticipate it? Very, very difficult, very hard to hedge. But when I look at the broader picture, this is an economy almost the size of the U.S. that's going to grow at 5%. Potentially grow at 5%. That's a positive. That's a net positive that I don't think is being fully incorporated into markets. Now, it's a question if that's already priced or not. I don't think it is. And that's one of the reasons that we still have somewhat more of a positive tilt in our investment strategies.
It's a question, of course, as to whether it's real or not. They can call it whatever they want, but ultimately to see the spillover, it's got to be there. Jim, always awesome. Jim Caron, Matt Miskin, breaking down these markets, going into CPI tomorrow, retail sales on Wednesday. Coming up on this programme, the morning calls, and later, a shallower but longer recession will begin in Q3. That's the view of Bank of America. We'll catch up with Savita Subramaniam around the opening bell. That conversation about 7 minutes away. 4 or 5 minutes away from the opening bell. Equity futures are positive by 0.2% on the Nasdaq. We're up 0.5%. Let's get you some morning calls. First up, Baird downgrading Caterpillar to neutral. 230 price target, moving to the sidelines after rallying more than 50% from its September low. Next up, B of A upgrading Ralph Lauren to buy, saying the retailer is well positioned due to the highly promotional environment. That stock is up by 1.9%. And finally, Evercore upgrading Zillow to outperform, $61 price target, expecting shares to benefit as the real estate market recovers. That stock up 4.5%. Up next, Bank of America's Savita Subramaniam joins us with her latest outlook after nailing the early rally of 2023. "25 seconds away from the opening bell this morning. Good morning to you all. Going into that opening bell, equity futures up by 0.2% on the S&P 500. On the Nasdaq 100, up 0.5%. Last week, the first weekly loss of the year on the Nasdaq, the biggest weekly loss of the year on the S&P 500. Still only down about 1 full percentage point, which, as I've said a few times this morning, maybe tells you more about the year so far than it does last week. That's your opening bell. Switch to the board and get to the bond market. Yields look a little something like this on a 10-year, higher by not even a basis point. Your 10-year right now, 373.78. Your 2-year earlier this morning through 4.54. Euro dollar, a break of 107 in the last couple of days. Right now, 106.87. That currency pair still positive, 0.1%. And last week, what a rally on crude. Biggest one-week gain on WTI, I think, going back to October. We were rallying more than 8% over the last week. Crude a bit softer, lower negative, down 0.5%. Crude right now, WTI, $79 and about 30 cents. About 30 seconds into this session, equity markets look a little something like this. On the S&P 500, positive 0.2% on the Nasdaq, up 0.3%. One stock to watch at the open, Manchester United. The club's said to be inching closer to an offer from Qatari investors. Ed Ludlow on the story. Morning, Ed.
Yes, good morning, Jonathan. Stock for Manchester United back towards that $25 per share mark. What sources are telling us is that Qatar's investment authority are working with family offices in the nation to come up with this bid, which sources say will be taken to Manchester United by the end of the week. In terms of what that looks like, Bloomberg's already reported, as you know, Jonathan, that the wisdom in the marketplace is that it would have to be above £4 billion, $4.8 billion, in order to be successful. But that in turn would make it one of the biggest deals for a sports franchise in history. This is a long-running saga. It was back in August that Bloomberg first reported the Glazers were considering some sort of financial transaction. They confirmed that in November, and you'll remember that the stock essentially doubled when they came out with that statement saying that they were looking at strategic options, including a sale. And since then, there have been a number of developments with the Qataris coming in more recently. You'll know as well, John, that British billionaire Jim Ratcliffe had also declared his interest and is working with Goldman Sachs and JP Morgan on a potential offer. But it looks like the Qataris are serious about this. And as I said, sources see this happening by the end of the week. They're working with Rain Group, John, in New York to make this deal happen. We'll see if it does. Ed, I know this is really complicated, but the Qataris have a financial interest, a rather large one, in Paris Saint-Germain as well. Does that complicate the potential of closing this deal and those two clubs potentially in the European Cup competitions playing each other? Yeah, I think, one thing I would say in response to that, John, is sources did stress that the composition of the bid is not yet confirmed. So the Qatari Investment Authority is kind of working in a consulting role, our sources say, alongside considering adding capital with a number of the family offices that are involved. And as you said, the complicating factor is the European football regulations on ownership, which has made a number of existing owners think again when they've tried to buy stakes in other clubs. So it's been a factor that's been reported on, but nothing in our Bloomberg report this morning mentions it. Ed, we'll stay on top of it. Thank you, sir. As always, that stock rallying in early trading. 2 or 3 minutes into the session, equities up by 1/10 on the Nasdaq, up by 0.2%. I want to turn to the financials, flirting with a 4th straight day of declines as Fidelity National leads the way lower after issuing a weaker than expected outlook. Katie Greifeld has the story. Hey, Katie.
Hey, John, well, let's talk about Fidelity National. That, of course, is the big news of the morning, down about 14% as trading gets underway. And as you mentioned, the 2023 outlook for both revenue and EPS came in lighter than expected. That's weighing on the stock. But the big news from this name this morning is that Fidelity National booked a $17.6 billion write-down on WorldPay, and that it will pursue a tax-free spinoff of that unit in the next year. And remember, Fidelity National bought this payment processor for $41 billion about 4 years ago. And if we look at how the stock's performed since then, it's been a bit abysmal, John. Shares are close down to 40% over that period. And Mizuho said today that the spinoff news shows that this acquisition was, quote, a huge failure. And this comes, of course, weeks after Fidelity National eliminated 2,600 jobs. Of course, it joins big banks in large-scale layoffs and restructurings with that news. We've seen similar moves from Goldman, JP Morgan, Credit Suisse, just to name a few. And as you can see from that chart, that's really starting to add up for the financial sector as a whole, John.
Katie, thank you. That stock getting slammed. Pretty ugly stuff. It's down about 13%. The broader equity market doing okay, up 0.1% or so on the S&P. Bank of America's Savita Subramanian warning that we're in the early stages of an earnings recession, writing the following. The next leg is driven by sales decelerating further, which we think is likely in a soft or hard landing. Here, companies typically can't cut costs fast enough, resulting in a more dramatic deterioration in earnings. I'm pleased to say that Savita joins us right now. Savita, fantastic to catch up with you. You said at the start of the year, the biggest risk was upside risk. You were dead on. We rallied really, really hard. Can you tell me now just how balanced those risks are looking up and looking forward?
Well, look, I think, thanks for the props. I think where we are right now is an environment where the narrative has shifted from first half down, second half up to first half up, second half down. And what I think is interesting is I still don't think investors are positioned for that. So I would argue that the pain trade might continue to be up. Now, one thing that's making me think that that positioning has actually shifted is if you look at some of the earnings data, we've actually seen pretty strong resilience from corporates, pretty strong resilience from consumers in terms of very strong spending data coming in our credit card data, which is real time, showing that January sales were actually a huge surprise to the upside. And then when you look at corporates, I mean, they've been very nimble in terms of cutting costs. So what we're watching is sales growth. I think that's really the linchpin of whether we get a soft landing, a hard landing, or some of the real optimists are arguing for no landing in the economy. And so far so good. But I think that as we've seen time and time again, typically the next leg down is just demand destruction. So we're watching for that. And, again, we called our report this morning, never underestimate the corporate sector or the U.S. consumer, because the U.S. consumer has what seems like insatiable appetite for goods. And corporates have this ability to navigate margin pressure quite ably, as we've seen even in the fourth quarter, where we had everything working against margins. We had massive cost pressure, a little bit of a drop in demand, and fourth quarter margins are only missing by about 20 basis points. So, well done, corporate America.
Savita, let's stay focused on the shorter-term tactical call, the potential for more upside risk. You weren't surprised by the rally. Have you been surprised by the composition, the leadership of that rally? There was this phrase that you and the team have used, new economy gain, pain, old economy gain. So that's new economy pain, old economy gain. Have you been surprised by just how much tech has led?
Well, sort of. I mean, I guess what makes sense to me is that a lot of this is really just a short covering rally. So if you look at the companies with the highest short interest actually had like a 2 standard deviation upside move in terms of just, kind of hedge funds and investors closing shorts in areas that were mostly tech heavy. So the losers of last year, i.e., long duration tech stocks, actually were the winners in January. From here, I think what could be interesting is to watch a transition from, the laggards of last year to some of these, what I would call medium duration companies, cyclicals with a little bit of a dividend growth angle. And that's an area that I still think is under-owned, is poised to perform pretty well in an environment where investors are shifting from, looking for returns from just price appreciation to total return. A lot of these cyclical companies are still trading at attractive valuations. Look at oil markets. I mean, we've seen a big move higher in oil, and I think energy companies have finally gotten supply discipline, capital discipline. We're hearing it from all of the management teams. Share buybacks are more important than production. So I think this is a really interesting time to stick with real economy focused companies that could benefit from potential pickup in CapEx.
Savita, where do large US multinationals fit in to that story? Because you've warned about multinationals, you've warned about the themes that supported stocks in the last 10 years or so reversing. Where do they fit in?
So I think, our view is globalization gains are in the past, and we're in an environment where big multinationals are scrambling to rejigger supply chains. They're moving plant and equipment back to the U.S. or to sort of, the friendshoring, if you will, Canada, U.S., Mexico. So there is a shift taking place. And for these multinationals, it's going to be potentially a draw on cash flow over the next few years. But I think the good news is, so I'm trying to be more positive these days, and I think the good news is that we could actually see a real productivity cycle. So companies that have taken advantage of kind of easy margin expansion from globalization, cost arbitrage, share buybacks, kind of all of these very easy mechanisms for earnings growth and per share growth during an environment where hurdle rates were 0, are now being forced to think about longer term productivity. And I think that could be the next source of margin expansion down the road. I mean, I think for multinationals, it's going to be a tough road ahead in terms of getting to that point where they actually have the ability to flex margins. But the good news is that they're trying, and I think that's something that we can expect in the future.
Savita, you talked about the credit card data that Mike Gapin and you and the team follow. Tremendous, looking for a better retail sales print. You've pushed out the recession call. I'm looking at some of the performance of bank stocks. Your own stock is up 7% year to date. Goldman's up about the same. Morgan Stanley's up 16. Citi's up 11. You came into 23 and you said the banks are not your mom and dad's stocks. They're not your granddad's, your grandmother's bank names. Now, Savita, what's changed about them, and why do you think they can carry on performing even if growth rolls over?
Yeah, I mean, I think banks are not holding the credit risk. So if we have a credit cycle, it's going to look very different from 2008 or even 2000. You know, when you look at corporates and banks in particular, they've been shoring up capital. Earnings volatility is lower than the risk of the market. And the credit risk has actually transferred to other spots like lenders to these high growth areas. And I would argue that, you know, private equity, venture capital, those are the areas that hold more credit sensitive and sensitivity and more rising interest rate risk than your traditional credit sensitive financials. You know, even commodities. Commodities usually lead to the downturn in the credit cycle. And right now, commodities look pretty healthy. So, you know, again, I think we need to really think about throwing out the playbook from the last few recessions and thinking about what's actually happening right now. We have a strong consumer. We have corporates that are aggressively tackling bloated costs. And we have a Fed and a government that are sitting on mountains of debt. So it's going to be different. And I think that's where we really need to think hard about whether you want to own, you know, secular growth, which I think is actually turning into more cyclical growth, or do you want to actually stick with some of these higher quality names that are in some of the traditionally more cyclical sectors like energy and financials?
Is that where that phrase of yours, Savita, comes from, where you say safe is now risky and risky is now safe?
Yes, exactly. Thank you for reading our research. So safe is now risky, risky is now safe. So when you think about secular growth tech companies, they've had a great 10-year period where, you know, the economy failed to restart. We had, you know, secular growth was the only game in town. Now we've got an environment where GDP is, you know, slowly but surely recovering. We've got some inflation, and tech companies have seen a massive demand pull forward during COVID and are now looking cyclically challenged as well as secularly challenged. I mean, I think the other shoe to drop for tech is just the regulatory background. When you think about cyber attacks, data privacy, this is an issue that's affecting the man and woman on the street. It's just like the financial crisis, right? In the financial crisis, you saw home ownership broaden out and affect the man and woman on the street, and financials were regulated. Today, it's cyber, and that could cause the next kind of push of regulation against internet and you know, kind of the tech companies that have had a free pass on regulation for a very long time.
Final question, just a quick one, because I know you've got to run. Just a yes or no. Bear market is over. Chris Harvey of Wells Fargo this morning. That's his line. Do you agree?
Look, I think that we're going to be in a muddle. I mean, I think that for the S&P 500, we could remain in this bear market for a while because we're in the process of right-sizing tech and everything else kind of getting bigger in the benchmarks. And that's not going to be a great environment for the S&P 500. But for the S&P 450, ex-Nifty 50, I think we're out of a bear market and things are only going to get better.
Savita, this was great. Appreciate catching up as always. Let's do it again soon. Savita Subramanian there of Bank of America. Thank you. About 14 minutes into the session, equities up a third of 1%. Coming up, the C-suite starting to have some regrets.
Now we're hearing more about margin pressure. We're hearing about companies dealing with that via layoffs. You know, buybacks are sort of back in the narrative.
The latest on Goldman Sachs up next.
There was a large expectation that we would see a dip or decline, significant decline, whether it was in jobs or the economy in the first half of the year. And so far, the evidence, it's not showing that. John, as you just said, some of the data coming out is much stronger than people expected.
And yet corporate America is still tightening its belt. From the big banks to big tech, layoffs spreading across industries. Goldman's chief admits they should have come sooner. The Financial Times reporting the CEO, David Solomon, told about 400 partners in a closed-door meeting the following. As the environment was growing more complicated in Q2 of last year, every bone in my body believed we should be much more aggressive in slowing hiring and reducing headcount. For more, let's get to Shanali. Hey, Shanali.
John, this is David Solomon preparing the troops for an investor day that is coming in just about 2 weeks at Goldman Sachs. Remember those job cuts, 3,200 jobs here, that came in the face of a business slowdown, as well as what David Solomon himself said was trying to do too much too soon when it came to that consumer bank. Now pivot forward to today, because what you have now is about 400 some partners, and those are key businesses in which they've actually won some market share. That is trading, that is investment banking. Even in an investment banking slowdown, you had Goldman Sachs come out above its rivals in advisory in a down year. So how does that set up for this year? Even some analysts that had some struggles with the way Goldman has conducted business over the last year, take Mike Mayo, for example, who wanted more transparency. He actually now thinks Goldman is undervalued, and part of his thesis for that case is the idea that Goldman can actually cut more jobs than that 3,200 that we've been talking about here. So remember, this is a matter of Goldman having cut jobs, but their pay still, their compensation ratio being about the highest it's been in a decade, and its fourth quarter compensation costs still being at record levels. Is it better to pay the people you have, John, more in a face of a talent war that's still going on, or is it better to cut jobs where you can so that those people can be motivated when they come into work the next day?
Chanel, you've got great insight on this, so tell us all, just how much pressure is there on David Solomon going into Investor Day?
The stock says everything, doesn't it, John? You have Goldman Sachs trading at less than 1.2 times book, where Morgan Stanley is at 1.8. This gap has only grown. When David Solomon took over as CEO of Goldman Sachs, his bank, by market value, was worth more than Morgan Stanley. So in 2 weeks, repivoting the bank, explaining the rationale behind pushing back on consumer, fixing up that asset management business, making it more balance sheet light, how all of that will increase returns for the bank is a key question, and then it's all about execution from there.
Shanali, thank you. Goldman down by about 0.4%. Some mean people might say European banking exists only to make US banking look good. Deutsche Bank in hot water over missold derivatives. An internal review shining the spotlight on some employees working around bank controls to sell overly complex products for big profits. Steve Aarons of Bloomberg has more out of Frankfurt. Steve, can you tell us how significant this is?
Well, I mean, it's the conclusion of a probe that's been going on for over 2 years. We've been reporting on it frequently. We've been covering it very closely. So this is the end now, and Deutsche Bank's own probe finds that some staff have been pretty bad apples and circumvented their controls to make a big profit and thereby probably boosting their own bonuses.
The spotlight not on them anymore. It's on Credit Suisse. Steve, just how big a challenge does that bank face over the next 12 months?
Well, I mean, we've seen a brutal stock price decline just last week because of earnings. It's just investors are really unhappy with the bank. It's almost bidden back to a historic low again. So, I mean, investors just don't believe in the turnaround plan. And, you know, the CEO and the chairman have done little so far to convince them otherwise. It's a really, really uphill battle for them.
It's tough now, too. We're down another 5%. 272 just screams. This is tough for Credit Suisse. Real tough. Steve, thank you, as always. For the broader market, it hasn't been tough at all, has it? A couple of months into the year, stocks absolutely flying. For this one, for this session, 22 minutes in, we build on the losses of last week with a gain of 1/3 on the S&P, on the Nasdaq up 0.5% with some sector price action. Here's Ed.
Yeah, John, modestly higher, 0.3% on the S&P 500. Your information technology, your big up performer, the group up a full percentage point. And energy, the clear laggard, down, pretty significantly as WTI a little softer early on in this Monday session. Otherwise, you're looking at some relative weakness in consumer discretionary and some relative strength in consumer staples. All eyes on that CPI print, John, Tuesday, and it'll give us the direction of travel for rates in 2023 and beyond.
Tons of Fed speak. CPI Tuesday, retail sales just around the corner, a busy one. Ed, thank you. Coming up, we'll get you the trading diary, the guide through the week ahead and into the weekend. Thinking about the weekend already. Forgive me. From New York, this is Bloomberg. About 25 minutes into the session, trying to take a bite out of last week's loss. We're positive 0.4% on the S&P, on the Nasdaq, up about 0.7%. That's the price action. Here's the trading diary. The White House press secretary speaking at 1 p.m. Eastern time. No doubt questions about flying objects and all of the above. Then on to tomorrow. Big inflation print with US CPI just around the corner. Plus, we'll hear from Fed President Barkin exclusively on Bloomberg TV right here on the Open alongside Mike McKee and myself. More Fed speak with Logan Harker Williams. Retail sales on Wednesday. Another jobless claims report on Thursday. Stick with us tomorrow. Just a fantastic lineup. We'll kick things off at 9 a.m. Eastern time with Mohammed Al-Arian. You'll hear from a ton of others as well, including the Richmond Fed president. We'll do all of that about 30 minutes after that CPI report. Going into that, equities up 0.4% from New York. That does it for me. Thank you for choosing Bloomberg TV. Good luck for the rest of the trading day. This was the countdown to the Open. This is Bloomberg.